welcome everyone. We've just reached the 100 attendees. I think people are still arriving, but we have more than 300 people registered, but we'll get started. Okay, welcome to this EDHEC Infra webinar on the volatility of unlisted infrastructure equity investments. Now, this is a slightly controversial topic which we have now run into a number of times, both with the users or the prospective users of the EDHEC Infra indices, because we report a volatility of total returns in the 10 to 15% range, depending on the type of infrastructure being considered. And some users find this a little high, either because this is not what they're used to, or it's not what they've been told infrastructure is like. So today we would like to try and clarify this question, because it's actually very simple. And there's plenty of evidence supporting the notion that while infrastructure assets deliver stable cash flows, they are exposed to a number of asset pricing forces that can change their value quite a bit over time. As it's often the case with infrastructure, it's a matter of changing your perspective from the project or the deal level to that of the market for financial assets as a whole. So let's try and do that today. And hopefully by the time we reach the end of this webinar, you will have a perfectly clear and well-documented understanding of the return volatility of unlisted infrastructure equity investments. So there you go. Your host today, so I couldn't change the slide, is us. I'm Frederic Blomberg, the director and founder of EDHEC Infra. I'm joined by my colleague Abhishek Gupta, who is heavily involved in the design and production of our indices and produces some of the results you will see today. Hello, Abhishek, are you there?
Yes, hi. Thanks, Frederic, and welcome you all.
So just a few words of housekeeping as always. We'll try and keep this to 30 minutes and try and keep 15-20 minutes for questions at the end and a couple of poll questions as well. We will take all your questions in writing, so please use the Q&A menu at the bottom of the screen and we'll answer in the Q&A window. If you add your questions there, we will try and answer them today. If we don't have time to answer all of them, we will have a follow-up message and we'll try and answer everything. This webinar is also recorded. Now, also very briefly in the interest of time, EDHEC Infra, some of you may know now, was originally an academic project at the EDHEC Business School funded by public and private sector research grants. Today, we're a commercial provider of indices for unlisted infrastructure investors. We produce more than 400 indices and sub-indices every quarter. And our indices are now used by major investors in the sector, from North America to Europe to Australia, for their investment research, to monitor investment mandates, and also to better understand risks in their infrastructure portfolio, which is our subject today. So our agenda. First, we'll consider a simple question, which is, does stable cash flows necessarily mean low return volatility? I will then review the evidence on volatility in infrastructure investment by looking at indices built with asset valuation appraisals, and then look at the appraisals themselves. And I will show you some evidence that appraisals do not really tell you the whole story about risk in unlisted infrastructure investment, but that if we look closely and we look at some publicly available data, we can see that the volatility of unlisted infrastructure returns is unlikely to be very low. Then my colleague Abhishek will give you a more detailed assessment of the impact of three key factors on valuations during the last quarter, so during the COVID lockdowns. He will show you how much valuations were moved by changes in future cash flows, obviously, changes in future dividends, but also by changing the interest rates and by changes in the risk premium. And you will see that a shock like COVID-19, of course, impacts sectors like airports or roads, but through the influence of interest rates and risk premium, it also impacts everything else. Hence, also some of the volatility that there is to report. Then Abhishek will give you 5 stylized facts to remember about return volatility and in unlisted infrastructure investment. This should be handy for your future presentations, your Zoom meetings, even your dinner parties, if that's where you like to discuss infrastructure investment. And then I will return for just a few concluding comments, one slide, and also for our customary poll before taking your questions. So first, a simple question, which is, I think, at the heart of many misunderstandings about infrastructure investment. Does stable cash flows necessarily translate into low volatility of returns? Now, infrastructure companies and assets are typically presented as being low-risk businesses, by which it's meant that they have predictable cash flows due to the characteristics of infrastructure, in particular the role of long-term contracts, their monopoly characteristics, etc. And with the stable income, it's expected that infrastructure will also deliver stable and substantial dividends. And all this is true. As far as we can tell from the data, when compared with comparable companies, infrastructure companies have more stable revenues. They have a lower volatility of revenue growth, for example, and they pay more dividends per dollar of revenue than almost any other type of companies once they have matured, once they've gone out of the development stage. In fact, we wrote a paper on this a few years ago, and at the moment, my colleagues, Tim Whitaker and Rebecca Tan, are in the process of producing a new piece of research that finds similar things. Well, it's much more detailed, but amongst other things, it finds that infrastructure companies are unique because of their revenue and their dividend risk profile. Now, the same infrastructure companies require long-term periods to repay the initial capital investment. That's another thing that's special about infrastructure. So at least found in infrastructure, it's capital intensive. Right? So you need very long repayment periods. And if you expect to receive future dividends over long periods of time, you're exposed to something called duration, the sensitivity of the value of your assets to changes in the interest or the discount rate. So for those of you who are less familiar with the fixed income terminology, this so-called modified duration that we're looking at in this presentation is the sensitivity of the asset price to a 1% change in the discount rate or in interest rates. Now, because of the importance of compounding, assets that derive their current value from streams of payments that extends very far into the future are more exposed to changes in discount rates, and that would be the case for infrastructure. So while these future cash flows may be very stable, their present value can change a lot as a result of changes in rates. Okay, so as a case in point, you see in the table on this slide, treasury bonds. Long-term US bonds, treasury bonds or UK gilts have the most stable cash flows of all, right? They're pretty much guaranteed to get paid. But because of duration, the volatility of these assets is actually quite high. So total returns on 30-year US T-bond index is 18% volatility, the volatility of total returns. So that's fairly significant. And that's because these bonds have a high duration of 20%, right? So every movement in of 1% and interest rate changes the valuation by 20%. Less long-term bonds like gilts or long-term investment grade corporate bonds have a duration in a 14–15% range and a return volatility in the 9–10% range. So again, an interesting point of comparison. Where does that leave us with unlisted infrastructure? Well, we also have 20 or 30 years of repayment of cash flows to repay, right? 20 years of time ahead, sometimes more. And in fact, in the infrastructure 300 index that we compute, the duration is close to 10, meaning that a 1% increase in the discount rate would reduce the value of the index by 10%. Now, this is simply by the nature of the cash flows and of the horizon of the investments. Long-term horizon of infrastructure investment. This is not the result of an asset pricing model or anything fancy like this. It's just a basic math of discounted cash flows. Now, the infrastructure 300 is more volatile than the bond indices that you see in this table. And you can see it has a volatility in the 12–13% range. Remember, it's equity. So the risk premium that goes into discounting these cash flows also changes over time, not just interest rates. All right, so for now, remember this. Investment with a super stable cash flows like treasuries are exposed to a lot of discount rate risk, and as a result, they have high return volatility. And because of the long-term nature of infrastructure investments, we can expect something similar for unlisted infrastructure equity. Okay, so now let's look at the appraisals that report the value of unlisted infrastructure assets over time and see if we find evidence of this volatility. So on this slide, I'm showing you the 10-year annualized risk and return numbers for two indices that are based on appraisals, the MSCI Unlisted Infrastructure Index, which is an asset level index, and the Preqin Unlisted Infrastructure Index, which is a fund level index, infrastructure funds. The data in the table is for the 10 years from Q3 of 2009 to Q3 of 2019, and that's because the Preqin index has a lag of 3 or 4 quarters. So the last data point is the end of 2019. But on the graph, you can actually see all the data until 2020 Q1. And we see that both of these indices report incredibly low levels of risk. So the Preqin index reports 10.5% annualized fund returns after fees and 3.1% volatility, which implies a risk return or Sharpe ratio of close to 3. And the MSCI Unlisted Infrastructure Index reports an even higher return at the asset level. Okay, that's normal, it's before fees. 13.4% on a 10-year annualized basis, but the same volatility and even a higher Sharpe ratio of 3.78. Now, to be clear, this is not possible. Nothing has a Sharpe ratio like that for 10 years. And the best deal of your life may have a Sharpe ratio above 2, but you'll do one like that in your lifetime. And an asset class that is cheap like that, so cheap, that it yields high returns for very low risk, it can stay that cheap for so long. So something is wrong here. And you could say that another way to look at this is that if an investment opportunity that really claims to have that kind of Sharpe ratio, a risk-adjusted returns which is that high, call the regulator because it's fraud. It's a matter of had Sharpe ratios like that. But rest assured, I'm not trying to say that unlisted infrastructure funds are fraudulent pyramids. I'm trying to say that the volatility of these investments is not well captured by this kind of data, the data that uses these appraisals. Compared with market data like the MSCI World Index, which is an equity index, which has a Sharpe ratio of 0.3, or US Treasuries at 0.34, which is a real world Sharpe ratio, or the Infrastructure 300, which we compute, which looks pretty good with a Sharpe ratio of 0.78 with 13.9 total return volatility. Here we're looking at things that are more realistic. So these very high Sharpe ratios and these very low levels of risk, it's too good to be true. It's sort of out of this world true. Now, for some of you, I'm sure that's not a surprise, but a lot of people still use these arguments and actually probably just think that they're acceptable. This is a notion, the notion that unlisted infrastructure has very low volatility. That's something that has become part of the pitch, in fact, for infrastructure. As you can see on the slide, we've received messages complaining about the level of volatility that we report, for example, on the left. And this sort of thing even gets in the newspapers. A few months ago, there was an article in the FT claiming that the Sharpe ratio of 3.8 that I just showed you, 3.78, was real. That got me a bit mad, so I had to write a comment on that day. And to my surprise, but this is also a sign that it's possible to have some sanity in this debate, the FT editor actually replied and changed the article and removed the reference to a Sharpe ratio of 3.8. That was a small victory for the truth that day. But anyway, it goes to show that we have this obviously inadequate data when it comes to measuring risk, but it still gets used. It still gets probably sort of sent around and printed even. So it's worth looking more into this. Why are the appraisals so smooth? So let's try and understand this a bit better. Because when we know that unlisted infrastructure has a long duration, it should at least be impacted by changes in interest rate, right? Which have been significant for the past few years. We know interest rates have moved a lot. So the answer is that in the approach taken to determine the correct discount rate in the DCF models, the discount rate is effectively what is smooth. This is the thing that has very little volatility. So if you look at your usual DCF formula on the right, we have the future cash flows, which can be adjusted, but actually, as this is infrastructure, they can also be expected to be very stable, as we already know. Actually, hold that thought, because my colleague Abhishek will show you in a minute that in situations like the COVID lockdowns, they're not necessarily that stable. But anyway, most of the time we know from the research that they're very stable. So that's one thing. The cash flows are stable, but the discount rate is also made of a very smooth risk-free rate that usually changes more or less, usually rather less than more, and certainly isn't tracking the term structure of government bond yields at the end of each quarter. So the risk-free rate is already going to introduce some smoothness, the choice of risk-free rate. And on top of this risk-free rate, we have an equity risk premium, which is also very smooth usually, because it involves three things. It involves a market beta, which is typically picked up from a listed infrastructure index. And as a matter of fact, it's very close to 1, so it has very little effect. And it's always 1. It really doesn't really change over time. An equity risk premium, which is also quite smooth because it's derived from the equity risk premium that you can observe in the market. So of course, it's updated every now and then. For instance, recently with COVID, I know that some valuers have increased their equity risk premium by 50 bips, but it's still something that changes very little, and also by steps that have not related necessarily with market changes, market values. And on top of that, we have an ad hoc liquidity premium, or something called lack of marketability premium, which is even more smooth because that has very little basis to change from one quarter to the next. It's usually always the same thing. The result is a discount rate that does not move very much. Hence a net asset value that does not move either. And these absurd risk measures that you see in the appraisal-based indices, like the Preqin one or the MSCI one we just looked at. Okay, so let me actually illustrate this point by looking at some of the publicly available data that we could all look at for 5 infrastructure funds that publish their valuation assumptions in some details. So to be very clear, we're looking at the portfolio of 5 open-ended funds here that invest in unlisted infrastructure projects, mostly in the UK, mostly contracted infrastructure like social infrastructure, renewables, some contracted roads and trams, a little utility, some cell towers, etc. So mostly what can be considered to be the lower end of the risk spectrum for infrastructure cash flows. Now, these 5 funds happen to be listed on the London Stock Exchange. So don't get me wrong, we're not looking at listed data, we're looking at unlisted data, but because these funds that hold that unlisted assets, but because the funds that hold these assets are listed, we have easily access to their valuation details. So it's kind of transparent for me and easy to show you this information because it's public information. But it's actually the same. That's done for every fund, whether they're publicly listed or not, because the assets are all unlisted assets and they're all valued in the same way. So these funds, they have very little leverage at the fund level. Okay, so they're basically listed baskets of unlisted infrastructure equity. This is really interesting from a research standpoint because we can use them as a nice proxy. And because they are listed and they report all their valuation assumptions, we can understand how they work, but also we can see how the market prices them on a daily basis. Okay, so let's look at their valuation assumptions in terms of their average discount rate. And sure enough, we see that the average discount rates changes very little. You could say that discount rates are sticky, right? So you see on the chart on the right, once you pick a discount rate, you kind of stick with it for the rest of your fund's life, which in this case is forever because these funds are open-ended. And of course, it varies from one fund to another. You can see that most of these funds have a discount rates that's around 7% today, but they all had a discount rate that was around 8% about 10 years ago. So they have decreased, of course, but they have decreased very slowly over time. There's one of those 5 funds called 3i, which is a notable exception. They've always had a higher discount rate, but they also they do slightly riskier investments rather than just contract PPPs. And they've made their discount rates evolve more over the past 10 years. Their portfolio has also changed more in terms of the type of assets. But because the changes are so incremental, they've basically been stuck in this band between 10 and 12%. Just like the other funds have been bouncing between 8 and 7% discount rates. So unsurprisingly, with such stable discount rates, the volatility of the change in net asset value, which you see in the table on the left, which is circled in purple, is low at 3 or 4%, okay, except 3i, which has a NAV volatility of closer to 7%. So now you can see why the appraisal indices, which are computed using contributed data from infrastructure funds, just like these ones, have a low volatility. It's because discount rates are very smooth. Incidentally, you can see that our discount rates, the ones that we produce for contracted projects in the UK, so this is the orange line on the chart on the right, is much more dynamic. It's twice as volatile as the 3i discount rate, and it's 5 times more volatile than the HICO discount rate. And that's because the Aggregate discount rate is computed using market inputs at this time of valuation. And we'll come back to that later. Now, let me show you something else about these funds. It's even more interesting. So far, we've already confirmed our assumption, right? We see this really low volatility in the appraisal-based indices. Okay, well, it must be because the discount rate is really stale. And we look at how the discount rates are reported in funds, and we see that, yeah, they never change very much. So the NAV volatility is very low. So, okay, everything is explained, but we obviously see that there's something missing in terms of picking up the vol. Now, these funds may not update the discount rates they use for the NAV of their unlisted assets in order to reflect market data, but they also report the sensitivity of their NAV to changes in the discount rate. They have to, I think it's by regulation. In other words, they report their duration. And if you look at what they report on the right-hand side of this table, you can see that the sensitivity to changes in the discount rate of the NAV of these portfolios, so this is the NAV of the unlisted assets, is around 9 or 10. In other words, if the discount rate was to increase by 1%, the NAV of these funds would drop by 10%. So this is a strong indication that the mark-to-market value of these and the returns of these funds can be quite volatile. In fact, if the discount rate was to increase, but the trouble is that we've seen that it really doesn't change that much. You can also see that this duration is very much in line with what we report in terms of the duration of the UK Contracted Project Index or the Infra 300. Of course, there are different portfolios, so the match is not perfect, but you can see that the order of magnitude of the duration is the same. Finally, if you look at the left-hand side column, you will see the NAV volatility that I was showing you earlier, which is in the 3 to 4% range, which, by the way, is matches very well with the volatility of returns in the Preqin and the MSCI appraisal-based indices, right? 3–4%. But since these funds are listed, we can also look at the volatility of their actual market price. Okay. And as you can see, the volatility of their market price returns is often twice as high as that of the volatility of their NAV. On average, the vol of market price returns is 75% higher than the net asset value volatility. And the volatility of their price returns and also of their total returns is on par with that we report in the Aggregate indices. So to summarize these points, we see that changes in discount rates have been very small, in some cases microscopically small. And this suggests that we are looking at mark-to-market. We're not looking at mark-to-market discount rates when we look at the appraisals. And note that these appraisals actually do not claim to be mark-to-market. They claim to be fair value, which is not exactly the same thing. But and that's fine. I mean, as far as the reporting is concerned, it has one use. The trouble is that it doesn't help us to pick up the risk, to understand the volatility. Because as a result of not being mark-to-market, these appraisals create a completely distorted view of the risk of unlisted infrastructure assets. Nevertheless, the same disclosures reveal a level of duration that suggests much higher volatility if only the discount rate was allowed to change to reflect the market inputs. And that's the key, because the market inputs, they have been volatile. Here on the left, you see the volatility of 10-year public bond yields in different jurisdictions. And you can see that it's somewhere between 1% and 2%, depending on the window. You want to look at 5-year or 10-year. The volatility of the yield on risk-free rate, on risk-free bonds, so we count to build your term structure of risk-free rate, is somewhere between 1% and 2%. Actually, below you can see an animation of the term structure of risk-free rates since the late 90s up all the way till today. And as you can see, this term structure of risk-free rate, this is the US and France, but we compute this for every country where we observe assets, is quite volatile. It changes a lot. Obviously, at different points in history, it changes more or less, but it does change. And of course, we can also have the risk premium, which we estimate using a multi-factor risk model from secondary market deals each quarter. And as you can see on the right-hand side, this risk premium is also volatile. On average, it has a volatility of, let's say, between 0.5 and close to 2%. Okay, so we have volatile market inputs, which if they were to impact these assets as per their duration, would give us a fair amount of volatility.
I'll continue with the rest of the presentation. So the question is basically the risk-free rates volatility that we have seen is around 1 to 2% range, right? And the discount rate volatility that Frederick was showing earlier is between 0.5 to 2%. And given that we saw the average duration is around 10 years over time, the question really is what the return volatility should be like, given that by this duration level, we can expect 10% change in price per 1% change in the discount rates. And that's something that we will look at in more details in the slides that are coming up. So I'll start with this section where I'll try to dissect the different DCF components and how they impact the valuations of infrastructure assets as measured by EDEC Infra. And that's particularly in the context of COVID-19. Well, first, I'll give you a bit background of our methodology. Frederick showed you this DCF equation earlier and how the three key inputs used must be carefully updated every quarter for the mark-to-market valuation of these assets. And to differentiate our methodology, I'll explain a bit that the interest rates that we use, we create a full term structure of the interest rates until the end of the investment. And that's calibrated every quarter using the government bonds. So for each company, we have a new set of interest rates depending on the yields on these government bonds at every quarter. Risk premium is also calibrated every quarter based on the secondary market transactions and a multi-factor approach that is used for all the assets that we have in the universe. And lastly, the dividend forecasts are also reassessed over time based on the updated financials of a company or any significant market events that could occur, such as the COVID-19 shock in this quarter. With this background, we see that all the three components have the potential to change the valuation every quarter. And now we will try to isolate each of these effects in terms of what they did to the valuations in the first quarter of 2020. We'll take an example with two companies here first, A and B, and they've been anonymized for the sake of confidentiality. The two companies have the same industrial superclass. They belong to the same country. The major differences are in the governance structure, that one is a project finance and other is a corporate, and the duration, that one is a much longer duration than the other. To assess the impact of valuation, we will change each of these DCF components one at a time and discount the cash flows back to the same time point to find the effect of each. As you see in these results, the first observation is their valuation. So company A is a valuation of 942 million pounds and company B is worth 7.1 billion pounds. So clearly company B is much larger in size just by looking at the value that we have estimated. Next, we look at the change in the revenue projection for the next 3 years after the COVID-19 impact. So the revenues between 2020 and 2022, so the next 3 years. In this case, the revenues of company B were reduced more significantly with a drop of more than 30%. And it resulted in a large drop in the future dividends, approximately 15%. And consequently, the valuation was reduced by 14% for this company. And in comparison, the impact on company A was about 2%. Next, we see the rates effect. So interest rates in the UK fell in this quarter. And we see the average across the term structure that for company A, they were reduced by 44 basis points. And for company B, because it has a longer life, they were reduced by 57 basis points. And the lower interest rates lead to an increase in the NAV, but the impact was much stronger for company B. We see that the valuation was increased by more than 15%, even though the impact of the change in rates was almost similar magnitude. And this impact of the rates on the valuation was so strong that it almost compensated, actually more than compensated, for the impact of lower dividends on the NAV, and it covered it almost completely. And lastly, we will look at the change in the risk premium. We see that company A and company B both actually, they had increase in the risk premium, but the effect was much stronger for company A. That's due to its higher leverage and lower profitability in comparison. But that's an interesting point here, that despite this higher increase, the NAV was impacted less for this company. And this is the pure effect of duration that we see in infrastructure assets. Company B had a much larger duration, almost 3 times as compared to A. And that's why, even though its risk premium increased less, the NAV was reduced much more. And now these 3 effects are not linearly additive, but if we change all the components together, we can see that on an aggregate, company B suffered a lot more by this COVID-19 lockdown impact. Now, this exercise can be repeated is actually done for all the companies in our universe, and we can combine it at several levels. Here we see that if we aggregate the effects of all the assets which were directly impacted by COVID-19, or in other words, they were immediately locked down as of Q1 2020. The 3 primarily impacted sectors are airports, ports, and roads. We will try to understand the impact of each of these factors here. First, the lower revenue forecasts due to the abrupt halt in their services led to a significant cut in the future dividends. And ultimately, the NAV was reduced by up to 15% in the case of ports, for example. So it had quite a significant impact on the valuations. Next, we look at the impact of rates. We see that the change in rates was similar for all the companies in the airport sector and the port sector. 38 basis points lower and 33 basis points lower. Yet the impact on valuation was much higher for airport companies. That's again due to their higher duration. Their duration was actually the highest in all the 3 groups. A small note here that the change in rates was rather small for companies in the road sector. That's due to because some of them actually belong in the countries where long-term rates increased in the first quarter. So on an average, the impact becomes small. And that's why the impact on NAV was rather small. Finally, we look at the equity risk premium. It increased for all the 3 sectors again in this quarter, which highlights their riskiness increased in Q1 2020. Risk premium increased the most for port sector, and the jump was about 114 basis points. But again, the effect was compounded by duration for airports and road sectors, where the hit of NAV was much stronger. Then continuing on the similar lines, we can address the impact across all the companies by text business risk pillar. So if you look at all the merchant companies combined, we see that they were impacted more significantly as their revenues are directly linked to the market activity. And their revenues saw a sharp drop in this quarter, which led to a 3.89% reduction in the valuation. The risk premium also increased the most, indicating that their risk in these businesses actually increased a lot more than other business model types. And it caused a reduction in valuation by more than 10%. Contracted assets have relatively stable business model. So their cash flows, purely due to the effect of COVID-19, were not impacted in this quarter. Now we can compare the similar effects by TIC's corporate governance pillar. Here we note that corporates, which are typically of merchant and regulated business model types, they were impacted a lot more due to the lockdowns until Q1 2020. They saw a larger drop in NAV of 2.29% as compared to the impact from revenues on projects, which include a lot more contracted type assets. The duration of corporates at 10.1 is also longer than the duration of project companies, which ultimately reflects in the impact on NAV by the changing risk-free rates and the change in the equity premium, that their NAV was impacted a lot more. Finally, we can aggregate all the companies that are there in the EDIC universe and see the impact on the overall universe on an aggregate basis. Here we see that average dividend forecasts were only slashed by 1.17% across the entire universe. So their impact on NAV was rather limited. We see that minus 1.2%, but that's on an average. As we saw that individual segments within the universe behaved very differently in that quarter. Next, we see the rates actually fell all across the board on an average, and they had a positive impact on the NAV, which compensated, actually more than compensated for the lower valuations due to the dividend forecast cut. Lastly, the average risk premium increased across the board and was by far the most significant contributor to the fall in NAV in this quarter. So we found out that it's not one sector or the other which can be impacted by purely the cash flows of these companies, but there are other effects like the risk-free rate changes or the premium changes, which could actually affect all the companies in the universe. So far, we have seen that it's all the three components of DCF, which could significantly impact the valuations of any given company. Now we'll summarize the points that we saw into some key facts regarding the volatility of infrastructure asset class. Point number one, and that's a very important fact, that the volatility of price returns is the major contributor to the overall volatility of infrastructure. Here we look at the volatility contribution of EDIC Infra Broad Market Index. Historically, 10-year rolling volatility of price return alone has been between 12 to 15%. And that has moved around a lot over time. But this shouldn't come as a surprise, given what we saw earlier, that even the small movements in interest rates or risk premia could lead to significant changes in the valuations of these assets, which have a very long duration. And second thing to note here is the cash yield, which is rather stable in infrastructure, actually has a negative contribution to the total volatility. So while your price return may move around a lot, your cash yield, which remains stable through time, ends up reducing the volatility of the overall index. Second, here we note that one of the key valuation components, that's discount rates, they're very volatile over time and they move around quite considerably. Here we have a 10-year rolling wall of average discount rates and its underlying components, that's risk premium and risk-free rates. We see that volatility of discount rates increased a lot over the period of 2012 to 2017 and 18, and it has been trending down since. This shift is primarily due to the prices in infrastructure, which we believe sort of peaked around that period of 2017 and 18, and they ended up saturating the risk premium. And since then, risk premium has rather been low and more stable, leading to the reduction in the volatility of risk premium. And another thing to note here is that in the recent periods, a larger contribution of these discount rate vol comes from the risk-free rate volatility actually. So even if risk premium doesn't change, you have this component here, risk-free rates, which keeps changing all the time. And that might lead to significant volatility in the index. Next message is somewhat similar to what we saw in the previous slide so far, that as the DCF components move around, the valuations also change. Here we compare the TICS industrial classes by the 10-year historical wall of average discount rates or risk-free rates against the volatility of returns. So these TICS industrial classes are at that level, as I've given some examples like solar power generation, road companies, and so on. And we note that there is a clear positive relationship between the two, which establishes the fact that the sectors in which companies faced higher volatilities of discount rates, they also had higher volatility of returns. And it's true for both discount rate wall as well as for risk-free rate wall. We can look at the same conclusion by duration. We know that these infrastructure assets have very long duration, as we saw in the previous slides. Thus, on a mark-to-market basis, their valuations must be quite sensitive to the movements of discount rates. And more so even in these low rate interest rate environments, since they have a non-linear relationship. So the NAVs become more sensitive to the interest rate movements. In this chart here, we look at the average duration and volatility of the same TICS industrial classes that we looked earlier. And while there are other factors in place, such as business models and governance structures of the underlying companies, but still this chart paints a clear picture that there is a strong link between duration and volatility of returns in infrastructure. And there's a positive trend between the two. Finally, I would like to show you a summary of all EDIC Infra global indices and leave you with some key volatility statistics. So EDIC Infra indices have a very broad range of volatility, going from 8% for some contracted indices to and some project indices actually, and to 20% for some merchant and project indices. So the spread is quite large between different indices depending on what you're looking at. The average is around 13% across all the indices that we have that we publish every quarter. Contracted, renewables, and utilities type segments, they have the lowest volatility among all the sub indices that we have in the platform. And I would also like to point out that utilities, especially, they have a very tight spread of 0.1% between their least and most volatile sub-index. On the other hand, we notice that merchant and transport indices, they are the most volatile among all EDIC Infra global indices, with the average volatility in the axis of 16% here. So this chart paints a clear picture, rather table, that the average volatility revolves around 12% to, and it can go up to 16%, 17% for different segments, depending on what you're looking at. Finally, I hope that these results provided you some useful insights into the volatility drivers of infrastructure assets. And with that, I'll hand it over back to Frederick, who will share some thoughts about what might be expected from this asset class in the future, and then take you to the end of presentation. Frederick?
Thank you, Abhishek. I'm back. Sorry, for some reason, my computer crashed. This happens only only during webinars, obviously. Okay, but can you see the slides again?
Yes.
Yeah, okay. So we're going to do the poll now. So let me just ask my question again, because I don't know exactly when I got cut off. But you got the picture, and I guess now you've heard two different takes on what's driving this volatility. We have risk-free rates that are volatile, we just look at historical information of 1 to 2%. We have discount rates that also are volatile, and we have an average duration across most of infrastructure in a 10 or so. So again, if you increase the discount rate by 1%, it decreases the value by 10%. So that should create some volatility. So what, given all these parameters, what is the return volatility likely to be? So you've had time to think about this now. So let me just go to pass through these slides and give you our poll questions. So I'm going to launch the poll while I'm at it. And we have two simple questions. First, infrastructure equity appraisals should reflect risk better by adjusting discount rates using market inputs. Yes, they are too smooth, or no, they are just fine as they are. There are a few questions already in the Q&A window about that, so we'll discuss that afterwards. But first, please give us your answers. And the second question, while you think, unlisted infrastructure equity investments can be expected to have a total return volatility of less than 5%, which is the Madoff fund, right? So it implies a very high Sharpe ratio. Between 5 and 10%, which would imply a Sharpe ratio between 1.5 and 3. So that's super good. It's like the top 1% of hedge funds, like the most savviest, most skilled investors on the planet. And the idea that they can do this repeatedly over 10 years is perhaps a bit difficult to believe. Between 10 and 15% volatility, which would imply a Sharpe ratio between 0.5 and 1.5. So we would be in the sort of basically investment grade, perhaps a bit towards high yield bond or combination of the two category. Or a volatility of more than 15%, which is a Sharpe ratio lower than 0.5, just ballpark, and that's basically equivalent to global listed equities. So I will let you answer these questions. I think I still have some answers coming through. The second question, I think obviously you know what we think, and I think we have a clear winner, and I think most of you have been either convinced by us or thought the same before we started. The first one is more difficult. It's really a matter of what these appraisals are for, and it's not necessarily the case that they should be computed any differently. I hope that's clear. We don't want to say with this work that the people who do these valuations are not doing them properly. They're doing them for one purpose. The problem we have is that this way of doing it doesn't allow us to pick up what we're interested in, which is the variance of prices and the volatility of returns, which we then need for the purpose of risk management, asset allocation, etc. Okay, I think most of you have taken the poll. I'm going to, there are a couple more candidates. I'm going to end it and share it. Okay, so hopefully you can see the results. Okay, so 83% of you have said that the discount rates were too smooth. They need to be updated using market inputs. So that's interesting. And when it comes to volatility, the winner is 10 to 15% with 77% of your votes. Only 3% would like to think that infrastructure should look like a Madoff type fund. Be interesting to know why. But anyway, okay, so that's really interesting. Thank you very much for this. So just one more, I hope my computer doesn't crash again. One more thing, and then we'll go to your questions. We have a few more minutes. I think Abhishek's results show very clearly how prices are formed and change, and therefore returns are volatile, not only as a result of changes in cash flows, which are more or less stable, but again, most of the time they are stable, but also through interest rates and risk premium. So the first thing that I want to know to say in terms of conclusion is that we know that the valuations of unlisted infrastructure have changed considerably over the past 10 to 12 years, right? This has been a theme, in fact, in terms of the compression of yields, the increase of the willingness to pay higher multiples by investors, etc. Objectively, infrastructure was cheap 10 years ago. I mean, we saw deals that were, I remember if we looked at the history of all this, very cheap deals. Infrastructure was, on average, probably underpriced because it was less well known, and also a lot of it wasn't yet privatized, etc. And it went through a period of what I like to call price discovery in slow motion. So instead of having something that's cheap and buyers and sellers do what they do, and the price kind of adjust towards the fair price very quickly. Here it took about 10 years for the price to converge towards something that resembles the risk profile. So over a decade, prices increased and the risk premium was compressed. Of course, this is partly driven also by the availability of liquidity, the increasing popularity of these investments, but it was also a normalization of the valuations, again, given the relatively low risk of the cash flows. In fact, in 2019, we published a paper which shows that we had reached what we call peak infra at the time in 2017. So this in 2017, when we start to see a number of ratios, in particular the price to sales ratios, these are very, very stable data, because the price is the price that people pay for the equity of the asset, and then the sales are the revenue of the company. So it's always there, and it's always a positive number. So it's very easy to look at price to sales ratio as a good indication of how prices change in this market. And they peaked in 2017. And if you look at the risk premium that we report here on the right hand side, which you've seen in the previous slides, and which again is extracted from secondaries. So this is the risk premium that we estimate every quarter based on what we see in the secondary market in terms of pricing. We can see that after a long period of decline, after the GFC, there's a spike in 2012. That's the Euro crisis, and lots of assets are in Europe in our data set. But then it kind of keeps decreasing, and then kind of plateaus around 2017. And ever since then, it's been somewhat stable, maybe even increasing a little bit. But that's partly because interest rates have continued to decrease. So that's why implicitly the risk premium increases a bit as well. Now, this large shift in valuations that we've seen over these past 10 years explains in part some of the historical volatility of returns. So when we report volatility of 12, 13%, it's the historical volatility of these returns. And because they've changed a lot, that contributes to this volatility. After all, volatility is nothing than the variance of prices, right? And in this quite special period for this asset class, the average price change for one unit of unlisted infrastructure risk changed by an order of magnitude. But now this period of transition towards more expensive infrastructure is more or less over. First, we see it in the pricing for the past couple of years, but also if you did not believe that before this year, you would now that you have COVID to convince you that infrastructure does have some risk and its price cannot keep increasing forever. We also have very, very low interest rates, unlikely to go further down and boost valuations. And on the cash flow side of things, these are companies that cannot increase their cash flows. Again, very, very much. I mean, for a given price that you pay for an infrastructure company, which would more or less be representative of a given amount of CapEx, you get an infrastructure asset, which by design can deliver a service up to its design capacity and not more. Right? If you want to add a runway, or you want to add a lanes to your road, or you want to add a new power plant to your power plant complex, you need to put in more CapEx, more money. But otherwise, for whatever money you've invested, you can only produce whatever the design capacity of that asset is capable of producing. In other words, this isn't a gross asset, right? So we have cash flows that can only grow so much. We have interest rates that are very, very low, and I'm not going to go much further down. And we have risk premium that have reached a plateau. And so it means, I think, that these large double-digit returns of the past decade are surely behind us. The risks, however, remain. The interest rate risk, or the duration that we've discussed at length today, remain. The COVID risks of the cash flows are there. Now we've all experienced them, so we know they're real. And even the risk premium, which is unlikely to vary as much as it did before, will remain variable and volatile. So all in all, this provides us with a risk profile which was probably more reasonable if you look at a kind of return to risk profile, you know, a kind of Sharpe ratio type view of the world, or some kind of risk return. If you don't like Sharpe ratios, because these returns are not perfectly symmetrical, another kind of risk return view, we have something that's more reasonable. But that's not necessarily what investors have been used to so far, because over the past 10 years, again, we've seen a lot of changes in valuations. Thankfully, we have the cash yield. So this is kind of where we started. We said infrastructure have stable cash flows. We know that. Actually, they also pay a lot of dividends. Infrastructure has an amazingly resilient cash yield. And infrastructure companies routinely pay a large proportion of their revenues as dividends. So the total return Sharpe ratio of unlisted infrastructure is likely to stay quite attractive, in fact, compared to other asset classes for the foreseeable future. So when we look at this, we continue to think that it's a great asset class, basically, but it's important to measure the risk because that's how we can understand first where the returns come from, also how to build our forward-looking return expectations, and more importantly, how to manage infrastructure as an asset class in the portfolio. So I'm going to turn to your questions now. I see that Abhishek has answered some of them already in writing. So that's cool. There was one that I thought was quite interesting, and I was going to go to first, which is from Chris Morgan. So thank you for your question. The question is, in your view, is it right to adjust discount rates used by investment companies to fair value their investments by movements in quoted risk-free rates or equity risk premium? Shouldn't the return targets of those potential purchases be considered such that the discount rates could be more sticky? So yes, I think you're hitting at something really important here, which is again what I was trying to say earlier. That these discount rates, these appraisals are computed. First, they're never called mark to market. If you read all the reports, they're called fair value. And the point is more, yes, what's the sort of price that we should expect if we sold this tomorrow, and not so much how much has, but even though it's related, how much has the price changed in the past quarter given the market fundamentals? See, if these views were sufficiently, you could say, accurate, the problem is I think they're targeting either a specific type of buyer or maybe the average buyer, I'm not sure. But the result that we see just by looking at the appraisals and the volatility of the appraisals and the volatility of the net asset values in those funds clearly indicate that we're missing a bit of the vol, we're missing a bit of the risk, because again, the risk return profile that we get is very unbelievable. In fact, if you look at the correlation of returns between these appraisals and other asset classes, you often find that the correlation is extremely low, if not zero. So think about this from an asset allocation standpoint. You're trying to determine how much infrastructure you should put in your pension fund, and you have zero correlation with stocks, zero correlation with bonds, zero correlation with anything. You can either, decide to invest some amount in a completely ad hoc way, which is what people do, or you could trust the optimizer, but then the optimizer will say, well, sell everything and only buy this because this has a Sharpe ratio of 4 and it's correlated with nothing. So we need to measure the volatility, but for a different purpose, for the purpose of benchmarking an asset class. So the answer to your question, I think, is that I think we should do both. It's probably, first, it's unlikely that the current practice somehow disappears, and it clearly has its uses. But what we do is, on top of that, to value the assets every quarter with the right term structure of discount rate in the right country at that time, etc., and with the risk premia which corresponds to that asset also at that point in time. And so that leads me to second question by Owen Scott. How do you get comfort over the appropriate risk premium increase? So this is also the key, of course, here. So the cash flows is one thing. We collect all this historical information, and we have a view on cash flows for all these companies, which is once again with infrastructure, luckily it's not too difficult to make cash flow predictions and to get them right, because we understand these assets very well, and they do have a very stable business. So we have the cash flows. We have the interest rates. That's easy as well. We should get all the data. And as you saw, I was showing you the little term structure of videos that we have. We can have all the relevant data. The key is to get the risk premia. And the risk premia, the trick is to be able to come up with a price for risk every quarter, considering that in any given quarter, only some assets will trade, but most assets don't. And so, especially if you're trying to price an airport, for example, but maybe this quarter only a road and a power plant and a few wind farms were traded, well, what do you do for your airport? How do you find your comparable for your airport? In order to be able to do this with comparables, as you do, for instance, in real estate, you would have to have hundreds of assets that are trading all the time. And as we know, of course, infrastructure doesn't trade all the time. In fact, very, very infrequently. So what we do is to price, instead of trying to price hundreds of assets, we price 6 factors. And once we have priced these 6 factors, so which are the factors that explain the discount rate of the deals. So we see the deals, we see how much people pay for the road and the power plant and the 3 wind farms. And from these deals, we extract the latest value, the latest price of those risk factors. One of them is the leverage, the other one is the profitability of the company, etc. I'm not going to go into this now, it's too long, but basically we have this risk factor model. And once we've updated the price of the risk factors, because all the companies are exposed to the same risk factors, we can price all the companies. Just then becomes extremely simple. So we've reduced the problem of pricing hundreds of companies to pricing 6 factors on each quarter. And we can do that because these factors are found, the exposure to these factors and the price of these factors is found in every company that trades just in different quantities. So it becomes a big econometric question, but it ceases to be a very complicated financial question. Right, so I wanted to answer these 2 questions because these are really key. Why do we want to measure the volatility, and how do we do it, which is one of the key elements being the risk premium. I think we've otherwise run out of time. So I'm going to stop here.